Bank of England's latest policy decision just out, and as expected, there is no change on interest rates or QE. So the base rate kept on hold at a record low 0.5%, and the bank's quantitative easing programme also kept on hold at £375 billion. Well, let's get out now to Richard Maguire. He's Senior Fixed Income Strategist at Rabobank. Richard, what's your reaction? Pretty much as expected. Do you think there's going to be one more QE salvo from the bank, or is that it?
No, we think that they will commit to further quantitative easing. We think they'll do that by February next year at the latest. Obviously, we have the November inflation report published next week. That will allow the bank to publicly communicate its thoughts on growth and inflation. Certainly, I think there is some scope for a downward revision to its growth forecasts. The inflation forecast will be absolutely key as to whether they project sub-target inflation over the two-year policy horizon with the current level of stimulus. If they do, then that certainly will give a nod to further stimulus on the way. The reason why they held their hands today is most likely because of the strong Q3 GDP print that we saw, but subsequently the data has printed softly. There are considerable headwinds facing the UK, not least because of the US fiscal cliff, but also the outlook for the Eurozone is getting weaker and weaker, and we think that will push the MPC into the arms of further quantitative easing. We think another 50 billion sterling, as I say, by February at the latest, but certainly December is not an impossibility by any means. OK, I mean, that decision was widely expected, but there was obviously somebody somewhere in the market, FX and rates, expecting some easing because cable has popped up about 15 ticks rather, to 159.65. The two-year yield also up a couple of basis points to around, 24 basis points. And the 10-year yield, 10-year gilt yield up 2 or 3 basis points to 1.77%. That was the positioning before today's decision, Richard. How do you think the market will be positioned now? Well, they've pared back a little bit of their expectations, but only modestly so. As you say, the moves that you highlight are minor. There was some, perhaps, expectation that there was a small chance of additional stimulus at this meeting. 9 out of the 44 economists polled by Bloomberg did look for additional quantitative easing between 25 and 50 billion. So there was a small probability priced in, and now that's been priced out. OK, moving on to Spain. We had bond auctions today. They went pretty well. Demand was OK. They sold more than forecast, and that's their 2012 funding done and dusted. Yet yields are rising today. Why is that? Yes, I mean, there appears to have been a little bit of indigestion post the sale. As you say, it was reasonably reassuring in that the Spanish Treasury got away 4.76 billion worth of 3-, 5-year and 20-year paper. So that's more than they had expected to. The indicative range was 3.5 to 4.5 billion, and that completes their funding for the year. There was a rather large tail, though, on the 5-year paper, which has seen primary dealers having to shift it subsequent to the auction, which is putting some pressure on SPGB yields across the curve. And I think the market really now is turning its attention to if and when Spain will ask for a bailout, and we would expect pressure to continue to build from here. Obviously, in the coming weeks, that pressure is somewhat academic, given that Spain has completed its funding programme. We had thought earlier that Spain might request a bailout before the end of the year. That's certainly looking doubtful now, but we do think that pressure will continue to build. We think the Catalonian elections are a trigger for additional pressure, as is the ever-deteriorating outlook for the Spanish economy and the diminishing likelihood that they will meet their fiscal targets, or an increasing likelihood that they will overshoot by some significant margin. That will also add to pressure, and so for now we would expect that assistance will be requested, but early in next year, probably the first quarter. OK, Richard, thank you very much. Well, today's chart of the day looks at euro-dollar, which is running into some pretty heavy selling. The single currency today hitting a 2-month low, well below its 200-day moving average. That keeps it in a declining channel that's been in place for close to 3 weeks. Barclays technical strategist Phil Roberts says watch out for a sustained break of 127.30. If that happens, he says the way is clear for a move down to 126.05. And in equities, Siemens outperforming after it announced Q4 results. Net profit slips 2% to 1.48 billion euros, but that's still above forecasts. Investors taking their cue, though, from the company's pledge to cut costs by some 6 billion euros. Shares last up almost 4% to their highest since August last year. And you can see my interview with CEO Peter Loser on demand and on Reuters.com. Well, that's all from us for now, but join us again at 1:30 London time when we'll have full coverage of the ECB news conference following today's policy decision by the central bank. And we're back every day at this time to take the pulse of the market. I'm Jamie McGeever.
This is Reuters.